Today, the thesis that democracy requires a wide distribution of wealth is a given. However, reality looks different. In Germany, for example, before the meltdown in 2008, the richest 20% of the population owned 80% of all capital assets, while 50% owned either no assets at all or had only debt. Social, economic, and political dangers result from this disparity. Such the latest findings of British researchers Wilkinson and Pickett, which show, amongst others, a direct correlation between inequality and lower life expectancy as well as a higher crime rate, confirm the detrimental effects on society. But capital concentration itself is economically dysfunctional. Who is going to buy the washing machines and houses if the purchasing power of the vast majority of the population is in decline? This production-consumption gap is the Achilles heel of the free market. To put it simply, machines just don't buy cars. Furthermore, if the equation ownership equals independence is true, its reversal is equally true. Non-ownership equals servitude. The concept of welfare redistribution under the rule of law attempts to correct the harsh formula, those who own command, those who do not serve. The alternative to redistribution is a policy promoting wider ownership. If ownership were more evenly distributed, self-interest would take over much of the tasks of welfare. Therefore, democratic governments all around the globe ask themselves how to turn this analysis into public policy. Now, let us see what the rationale behind a policy that guarantees equality of economic opportunities is. The democratic state, under the rule of law, guarantees equality of opportunities for its citizens, that is, a level playing field. Examples are fundamental rights, court-appointed defense counsel in criminal proceedings, or the guarantee of equal access to public education. In our free market society, this guarantee is broadened to include the economic rights of citizens. Therefore, equality of economic opportunity through equal access to capital credit in order to acquire productive property must be a cornerstone of the rule of law. The ideal should be to make charity unnecessary by enabling people to produce their own living instead of leaving them to the mercy of others. Welfare is humiliating and detrimental to human dignity. Otherwise, there would be no working poor. For these reasons, we need to promote financial techniques that broaden ownership of productive assets. So, how do we square the circle that the rich get richer while the poor stay poor? Traditionally, the way to asset formation for the poor is savings through foregone consumption. But what can you save when you have barely enough to make ends meet? If we agree that, when financing business activities, that is, productive property, the bottleneck is access to capital credit, then why do we give microcredit to the poor while macrocredit is only available to the rich? We are flooded with consumer credit at 0% interest, but try to get, let's say, 10,000 euros to set up a business instead of financing your new car. That's when trouble begins. But a car earns no income for its owner unless he rents it out or sells transportation services. Quite the contrary. A car is a cost. Thus, the key question is, how can we open the capital property system to those historically excluded from it? This is the vast majority of citizens, the ones the American lawyer and investment banker Lewis O. Kelso called the hereditary poor. The eye of the needle is financing productive property for the many. This is what the employee stock ownership plan, the ESOP, invented more than 50 years ago by Kelso does. It uses the borrowing power of a company to acquire shares of that very company for its employees. The cost of credit financing is covered from the future earnings of the shares. As to the feasibility of the concept, Wall Street has been employing these techniques, its prototype being the leverage buyout, successfully for many decades now, but, of course, for the already rich. An ESOP usually involves a loan to an employee benefit trust, which acquires company stock and allocates it through periodic contributions to each employee's ESOP account. The loan is serviced by payments from the company out of company profits or out of dividends paid on the stock held by the ESOP. Today, there are more than 11,500 ESOPs with over 10 million participants in the US. But in the future, also less common financial tools as the General Stock Ownership Plan, the GSOP, or the Consumer Stock Ownership Plan, the CSOP, must be taken into consideration. The difference to the ESOP is the group of plan participants. In ESOPs, its employees. In CSOPs, it's consumers of a utility, and in GSOPs, it is citizens of a region. In the case of the latter two plans, instead of the value of the company, it is usually government programs that back the capital acquisition loan. All plans are based on the same financial logic, that is, to finance the acquisition of productive property out of the future earnings of the object of acquisition. Instead of using savings, the cost of financing the investment is covered from the proceeds of that very investment. Therefore, governments must actively support broad asset formation in the hands of their citizens.